Good evening. Good evening. It is your girl, Jocelyn Harrison, and welcome to Navigating Now. I try to be a woman of my word. I try to do that. Earlier this year, I had Wanda Watson as our guest, and we talked about navigating your money. And we talked about mindsets and just some personal things that you could do around budgeting and just preparing yourself for the future. And it was so chock full of information. I knew that we couldn't get to everything that's within her expertise. And so I asked her to come back, and she is here with us. Wanda Watson is the owner and founder of Premier Small Business Solutions in Virginia. And she is here today as we discuss navigating tax strategies. Yes, y'all, it's that time of year. Now, some of you all may have already done it. You may have already filed taxes. You already have a process. You feel like you're good. But I know as a person with an accounting background that with taxes, there's always strategies, there's always things that we can look to improve upon. And they're always changing tax laws. So we have to, this is my humble opinion, work with a professional. You may be, like, no, I got this covered. I'm sitting at my table. I always get some money back. I always, or whatever your situation is. I wanted to bring Wanda back today so that we can talk about what we can do to ensure that we have a greater understanding of the process of filing taxes, as well as what we can do to minimize our tax liability and whatever else Wanda wants to share with us. So stick around. I don't care if you have a tax professional. I don't care if you do it yourself. I guarantee you there will be some information here that will be of some help to you. Wanda, welcome to Navigating Now, girl. How are you doing?
Thank you. Thank you. Thank you. I am great. Thanks for having me back. Thanks for having me back.
Well, thank you for saying yes again.
Absolutely.
I will just get started because I know I have some questions, and I'm sure people have questions. If you have questions, please put them in the comment section. If for whatever reason we don't get to them verbally, we will definitely make sure that we respond in the comment section. And if you are watching the replay, please put hashtag replay in the comment section. All right, let's just start off. Okay, when are taxes due for us people out here in the world?
Us people. Well, surprisingly enough, they did not move the due date. So it is still April 15th. And I say surprisingly enough because, as you know, they didn't even start accepting taxes until February 15th or February 12th. So I expected them to go ahead and push the due date out to maybe May timeframe, to allow for that month. But that has not happened as of yet. And I say as of yet because things are changing in the tax realm all the time. So, but as of now, unless you have a corporation, so if you do have a corporation, corporate taxes are actually due March 15th. So you only have a couple of weeks. Get out there, get it done. I hope you have your information together or what have you. And if not, you can file an extension. But just make sure that if you are incorporated, a C Corp, S Corp, that you file that extension if you're not ready to prepare your return by March 15th. And individual taxes are due by April 15th. And again, an extension can be filed. If you file the corporate extension in March, it is then due by September. If you file the individual extension in April, it's then due by October 15th.
Okay, so someone put that in the comment section for me. I mean, I know you are like, Jocelyn, we know our taxes are due on April 15th. I feel like we may as well start with the basics, okay? So if you are a corporation and that's an S Corp or a C Corp, not an LLC or sole proprietor, right? Because those are still due. They can be, well, because I know it all rolls up. I guess I'm about to dig a hole that I don't want to go down into yet. But basically, S Corp or C Corp.
C Corp. And I emphasize S Corp or C Corp because most LLCs are single member LLCs, and they are then filed on a Schedule C, which is included with the 1040.
There you go. Thank
Yeah.
you. So you got that right. If you're an LLC, it's on the Schedule C, well, single member, and then you can file April 15th with that.
Correct.
So someone put that in the chat for me. If you're S Corp or C Corp, March 15th, but you can do an extension, and then it'll be due in September. Is it September 15th or like the end of
September 15th.
September 15th. If you are an individual doing individual taxes, April 15th, but you can file an extension, and they will be due October 15th.
Correct.
All right. So we got that out of the way. The foundation out of the way so we can get to the good. Okay. So what are some good tips? Give me your 4 main, or however many tips you have, for ensuring that we have a hassle-free tax season.
Okay, well, first and foremost, you want to make sure you have all of your tax documents together. So by this time, everyone should have received their tax documents, whereas the 1099s, the W-2s, they were all due out at the end of January or February 1st, right? So any tax documents you receive, now some are still coming in late. I had someone reach out to me that just received their 1099B. Their 1099B is from the proceeds of the sale of stocks. You know, right now, cryptocurrency is big, a lot of buying, a lot of selling between the crypto and stocks and things of that sort. So a lot of those forms are being received kind of late, you know, but you want to make sure that everything that you receive pertaining to taxes, you have together for your tax professional, right? You also want to make sure that any contributions you've made throughout the year, that you have those together. Now, some people, they get the little slips from Goodwill or what have you, and they take it to their tax professional and they're like, well, here you go. And all it has is the name of the, you know, the vendor or whatever that you took it to, as well as the date that, you know, you contributed, but it has no detail, none. So let me just say that if you are audited, that's one thing that they will look for, detail, because that's how else would you come up with the value of that contribution. So before you take those little tags to your tax preparer, go ahead and detail that. As a matter of fact, make sure you detail them at the time of contributions, right? Because if you don't, you're going to forget what was in there anyway. So you want to do 5 blouses, 6 slacks, whatever. And that's how we determine the value of the contributed item, right? So that's what I say, that's number 2. If you have a business and you have an office in your home, when you go to see your tax preparer, part of what you need to have compiled are the expenses for your home office. Okay. And additionally, make sure you have your mileage log. Now, your tax preparer may not want to necessarily see the mileage log, but you have to have one in the event of an audit as well. So I always ask, did you track your mileage, right? So very important. Yeah. I think you're muted.
I was. So three main things. Make sure we have all our tax documents, W-99s, etc. Make sure, and the 1099B is for sale.
Right, there's so many different 1099s now.
Okay.
So yeah, if you are an independent contractor, you probably received the 1099 NEC, right? If you received any sort of pensions or what have you, you have another 1099, a 1099R. If you sold stocks, you have a 1099B. So yeah, they're various. If you sold a home, you probably have a 1099S. So yes, make sure whatever you receive, if you had interest on a bank account that exceeded $10, then that bank sent you a 1099 INT. So you want to make sure you have all of that you take to your tax professional.
Okay. Okay. And then if we are making contributions to anything, just make sure we have some detail, not just goodwill, $100.
Correct.
Okay.
Correct. Yes.
And make sure you have a mileage log with that as well. Oh, I'm sorry, I'm skipping ahead. So that's contributions. And then if we have a home-based business,
Mhm.
then we want to make sure that we compile the expenses for the home office,
Correct.
including a mileage log, which is very important.
Right. So the mileage log really doesn't necessarily pertain to the home office, but if you do have miles, in relation to the income that you generated, you want to make sure you have a mileage log.
Okay.
Now, the home office, that gets more into, you would need the square footage of the home
Okay.
and the square footage of the office to determine what is the percentage of the home office in comparison to the entire house. So maybe let's just say the home office is 10%, right? So then there's two different ways to do that. You can take what's called a simplified method. And, if you say it's 120 square feet, the simplified method is $5 per square foot, right? So then you have a $600 deduction. A lot of people would prefer to do it that way. However, if you do the work, that $600 could be much more, right? Because you're now taking 10% of your utilities, 10% of your mortgage interest, 10% of real estate taxes, and whatever else that you have that are attributable to the home, and you're now able to write that off as a business expense.
Okay.
And you know why that's so important? Or maybe you don't, but let me tell you why that's so important. Because if either way, it is minimizing your bottom line. And then the goal is definitely to minimize your tax liability, right? But when you're filing as a Schedule C filer, keeping in mind that whatever that net profit is subject to Social Security and Medicare tax, which is 15.3% on top of your actual tax liability for federal and state. So you really want to be mindful of that because that's adding to. So taking that home office deduction is important. I've had people say that they hesitate to take it because they think it opens them up for an audit, but just do it right. Keep your documentation and don't be hesitant to take anything that's legitimate that legitimately reduces your tax liability.
Yeah.
Right? Yeah. Because as I always say, that, it's called the IRS. So they believe that whatever you make is theirs if you put the and IRS together.
Oh my gosh, that is so funny. I never thought about
theirs. So don't let them have it. Tell them, no, this is mine. It's not yours. So take whatever deductions you can take. Legitimate deductions, of course. Yeah.
Somebody put that in the comment. Put not theirs. THEIR. Gosh, it's mine, not theirs, mine.
Right.
Oh my goodness, I've never thought about that. Oh, that's hilarious and so true.
Yes.
Very true. Oh my goodness. Okay, so right, of course, Wanda and I talk anyway, but I know that over the last year, there are probably more people working, and you mentioned already some strategies that we can use. So while people are working from home, there are more people doing side jobs or side gigs or, to bring in more money. What do we need to think about when we're creating our own gig economy? I know that's not what it really means, but our own gig economy.
Yeah. So, again, the same thing, because typically that income is going to go on a Schedule C, really depending on, the level that you actually work that business. Typically it's going to go on a Schedule C. So you want to make sure you take as many deductions as you can to minimize that bottom line, right? But it falls within the same realm of the business use of the home. Now, it depends on the actual gig. I've seen so many people in this time, with COVID times that are taking advantage of DoorDash or Instacart and things of that sort, right? It is so important to make sure that you track your mileage for those. Now, DoorDash typically will give you some detail on your mileage, right, that you can use. And there's typically not a lot of other deductions that you may have because you're going to go, you're picking it up, you're taking it to. But keep in mind those things that you may not forget that DoorDash is not going to detail for you, such as the business use of your cell phone, right? So, you know, even with that, with Instacart, whatever else it may be, I'm sure there are many that I don't even, you know, am unaware of, but keep, you know, those things in mind. And that's why it's so important to seek a tax professional, because there's so many things that you could be leaving on the table. You know, I had a young lady just call me recently because she did TurboTax and she was excited and she got her money back, but she realized that she could have gotten much more and she wanted me to fix it. So she saved money using TurboTax, but then she had to turn around and pay me to fix it.
Oh, so
right?
you like say you file and you realize, oh my gosh, I should have added that. They talk to you and they realize that it can be fixed.
Yes, it's called amended. We can amend the tax return, right?
Okay.
But you ultimately end up paying us at least what you would have paid us to file it to begin with.
Wow.
So you might as well just come to us first.
Right.
Right?
Yeah.
So my thing is, you know, do what you do best and let us do what we do best.
Yeah.
Right? Yeah. Yeah. Just come to us first. You know, I may have shared this story. I typically share it a lot about the you know, getting my car repaired. So I put oil in my car because it said it was low. And next thing I know, it's smoking. So I took the car to the mechanic and he was like, well, what do you do? I'm an accountant, right? So he's like, I bet you're good at it. Yes, I would like to think so. And he's like, well, I like to think I'm good at what I do too. He says, so let's make a deal. The next time you have a problem with your vehicle, you bring it to me, right? And you stick to what you do best. He's like, I may even need your services, right? And the reason he said that, because my car was smoking because I had put an excess amount of quarts of oil in it, trying to make sure the light went out. And it was smoking. Yeah. So I say the same thing. I use that same analogy when it comes to taxes. Stick to what you do best. Make that money. Make all the money. Don't minimize your income potential. Because I have had clients say, well, I don't want a big tax liability. So, you know, I only want to make X amount of dollars. Well, I'm sorry. I don't subscribe to that mindset. You make the money. Let us help you with reducing your liability, but make the money.
Yeah. I like that. I like that. So we focus on making the money, and you, the tax professional, will help us reduce the liability. So less is coming out of our pocket.
Absolutely.
It's ours. It's not
theirs.
Come on, somebody.
Right. Yes.
So I just want to be clear on this. Just because you're working from home, say your employer has you working from home, there is no write-off, right? Is there anything an employee who is now working from home can write off?
Yeah, so not so much, but they can talk to their employer, because if they are working from home, the utilities are higher and things of that sort. So there are some employers that are giving them some sort of compensation for the increased expenses, home expenses, right? So I would say talk to your employer, because the business use of the home deduction is not, you know, something that's can be used by a W-2 employee. Yeah, okay. There used to be a Form 2106 that was used if you had employee expenses, right, that were not reimbursed by your employer, but that went out the door with the Tax Job Act under the Trump administration, so they can no longer take that. And it hurt a good amount of people. Typically, what I've seen more are travel nurses, you know, and, you know, I have a few clients who are travel nurses, and, you know, that they couldn't use that 2106. And as you can imagine, they have a number of expenses pertaining to travel. So I, sent them back and was like, whoever you're working under, whatever agency or whatever, see if they're putting something in place to reimburse those things, because they really kind of shot them in the foot.
Yeah, that's interesting. So I really want to get to, okay, before I go there, so for the W-2 employee,
Mhm.
really they just need to make sure if they're going to itemize, if there's anything for them to itemize, because there's a standard deduction. Can you, because I'm sure everybody knows this, when do we do the standard deduction versus itemized deductions?
Right. Okay. So you itemize when you have enough deductions that actually exceed the amount of the standard deduction. And your standard deduction would be contingent upon how you file, whether you're married, filing joint, whether you're married, filing separate, whether you're an individual, or what have you. So, so say you're married, filing joint, and then the standard deduction is 24.4, right? So your itemized deductions would have to exceed that 24.4 in order for it to be beneficial for you to itemize. Now, here's the thing. When they implemented that, they disallowed the exemptions. We used to have like the $36.50 per member of the household and what have you. All of that was phased out when they increased the standard deduction. So now, whether you have 5 children or 1, it's still the same deduction, right? So you do want to keep track of it, but typically, unless you own a home or you're, really faithful tither, and an offering, love offering, and you typically will not exceed that number. So most taxpayers, outside of owning a home and being very faithful and generous with their contributions, typically will not hit that number. However, the things that make up the bottom line for your itemized deductions, the things that you can take into consideration would be your mortgage interest, would be your real estate taxes, would be your personal property taxes. Okay, and then obviously your charitable contributions. And then your health deduction obviously is at the top of the itemized deduction form. Again, you don't have the benefit of the health deduction unless it exceeds the 7.5% of your adjusted gross income, which most people do not exceed that number unless it's been a hard year and they have a good amount of medical expenses to write off. But you add all those together, and whatever your bottom line is at that point, you compare that to the standard deduction and see which one benefits you more.
Okay.
Right?
So that was and if someone wants to put this in the comment section, that would be great. If not, that's okay too. So mortgage interest, real estate taxes, personal property taxes, charitable contributions, and health deductions, which have to be 7.5% of adjusted gross income, or higher than 7.5%.
Right. So your health deductions are not counted unless they exceed 7.5%. And at that time where they exceed 7.5%, that's when they start adding up.
Okay. So you take the excess, you take the portion that exceeds the 7.5%?
Correct.
Add in. Okay.
Yes.
Okay. So do y'all have that? Mortgage interest? And I know some of you may be saying, I know that, but maybe you don't. Mortgage interest, real estate taxes, personal property taxes, charitable contributions, and the excess of your health deductions that exceed 7.5% of adjusted gross income. Okay, so that's what you would add up for itemized and see if it is more than the standard. If it's not more than the standard, take the standard.
Correct.
Okay. Now, for any newbie that may be watching this, who may be new to the work world, you just graduated college, you never really had it, you may not have, this may be your first time doing taxes. What are some key terms that people need to know? Like, what is adjusted gross income? What does that mean for the taxpayer?
Yeah, good question. Good question. Good question. And for our newbies, congratulations for entering into the adult world and, having them file those taxes. My daughter's one for the first time this year,
Okay.
she's on her own. And so now she's, learning about the education credit that she can now take and what have you. So the adjusted gross income, you're looking at all your W-2 income. You're looking at everything. You're looking at the proceeds from the sale of the stock. You're looking at the interest from the bank based on your bank account, your W-2 income. You're adding in any business income that you may have made and any other income. There are a number of items that you're adding together. And once you add all of your income, regardless of the origin, you'll get your adjusted gross income.
Okay.
Yeah.
And that is, so then we have our standard, then you have your expenses, right? So whether it's your standard deductions or if you have itemized deductions and if you have a Schedule C or credit, okay, or credits, okay. Then that
gets you to your taxable income.
Yes.
Right? So you have your total income, which is adjusted gross, and then you deduct all of that, your standard deduction, any credits or what have you, and that gets you to your taxable income, right? And then if you have that SE tax, self-employment taxes or whatever, there are other miscellaneous things that could be added to it, penalties and things of that sort, and what have you. And so to determine what your tax liability would be. So your taxable income and then a tax on that, and then it's adding any other penalties or what have you to it to get your total tax due.
Okay.
Yeah.
Okay. And so if we have, so in really thinking about this, when we are really looking at a tax strategy, should our tax strategy, and I don't know if I should use the word should, so you can correct me. Should our tax strategy be to net zero, or should it be to have money come back to us?
Yeah, good question. That's awesome. I love that question. I love that question because I have taxpayers, they're like, that's all I'm getting back? Well, my thing is, I'm glad that's all you're getting back because I had one client who was getting $11,000 back. I had a problem with that. My problem is you just loaned the IRS $11,000 for 12 months.
Interesting.
Right?
Yeah.
As opposed to you taking that $11,000 and making it work for you. Put it somewhere, let it earn interest, invest it in something. Because IRS is not paying you interest on that money. You're just a lender with no benefits. No. That is such a pet peeve for me. It's like, no. And so I know, right? So that's the thing. And so my thing is, I'd love to see you break even. Again, keep more of what you make. Break even. Owe them maybe a few $100s or whatever, or even get a few $100s back. I'm good with that. But when you're looking at getting back thousands and thousands of dollars, except for those who are getting it back because they qualify for the earned income credit or things like that, you know what I mean? But if you're getting it back because that's what you paid in throughout the year, and then they're giving it back to you without interest, okay, then we have a problem. That's why tax planning is so important.
That's good. That's good. Because I know plenty of people who reveled in the fact that, I got $5,000. It's like they look forward to filing their taxes because they get this money back, and it feels like a cash infusion.
Yeah.
And
yeah, but like I said, if it's because of earned income credit or child tax credit or whatever the credit may be, it's a refundable credit. then by all means, okay, yeah, that's great. That's awesome. I'm happy for you. But if it's because you had an excess of $5,000 withheld from your income and sent to the IRS so that they can hold it and use it as they see fit or whatever throughout the year, no, that's not the way to do
That's
it.
good. Did y'all hear that? I hope y'all heard that. That was a good nugget right there.
Yeah.
Okay. So thinking about, I'm still on the employee right now.
Okay.
How, I know some people who are masters at kind of manipulating their deductions, or like what, when they file, when you go in and you say, okay, I may be using the wrong terms. When you, what is it, your W-4? No.
When you complete your W-4.
When you go in and say, okay, 0 deductions or 1 or 2, I'm not using the right word, am I? I'm not, it's.
Okay, so you're speaking of when they complete the W-4.
Yeah.
That part you're correct. What has changed, again, due to the Job Tax Act and everything else, it really doesn't matter anymore, but you don't get the option of putting 3 or 4 or 5 or whatever. You just put single, married, whatever, or you can add additional to your withholdings and what have you. So that kind of hurt a lot of people as well, because what happened was they weren't having enough withheld from their taxes.
Okay.
Yeah. So that hurt a lot of people because they changed the W-4. But, you need to be mindful of that. And then when you file your taxes, if this is your first time, we're talking to the first timers, and then you owe, a decent amount of money, I'd say more than, more than a couple $100 if you owe, then you want to go ahead and make that adjustment. And that may be, asking them to withhold an additional $50 a month or whatever the case may be, or based on the frequency of pay, right? So you want to kind of keep those things in mind.
Okay. I couldn't find withholdings in my head to save my life. Withholdings.
Yes.
Okay.
Yeah.
Okay. And so I know the recommendation is for most businesses to do a quarterly tax payment.
Mm-hmm.
But with a person who is an employee, do you recommend a tax payment, or is it just to look at how they are having their money, the taxes withheld?
Yeah. It depends on what they have going on, because, we talked about having a side gig, right? So they may need to look at making those estimated tax payments, which are due April, June, September, and January 15th of every year.
Okay.
Right? So they may need to look at that, or they can look at going back and adding the additional withholding to the W-4 so that it's paid throughout the year, from their W-2 income.
Okay.
Yeah.
Okay.
But if they're really building a business, then yes, by all means, they need to be looking at the quarterly payments, right?
Okay.
So there's a model, is a profit first model. If anybody want to look that up, if you're a business owner. And with the profit first model, the mindset is you pay yourself first, your profit. You take your profit out, but then you have an expense account, and you have a tax account, and you have a payroll account, or what have you. And then, so therefore, when it comes time to make those payments, that money is sitting in the tax account for you to make it. You're not scrambling to determine how you're going to make that payment. So I really subscribe to that.
Okay. So in the comment section, someone please put profit, PROFIT first. You can just Google that. I know there's a book, there's a whole system that the creator has, of that. Okay.
Correct. Yeah.
First.
Yeah, the book is good. It's an easy read. It's really good. And I strongly recommend that, they look into that for sure.
Okay. Definite recommendation from our professional here.
Mm-hmm.
Okay. So am I missing anything else that like a regular W-2 employee needs to understand before I ask my next question?
Okay, so one thing I do encourage for W-2 employees is to look at the employers retirement plan.
Okay.
Right? Because if your employer is matching up to 3% or whatever that number is of your contributions, then you want to at least contribute up to the employer's match. So in other words, take advantage of being a W-2 employee because that comes into play for your retirement. That helps you to build your retirement account a little bit faster.
Mm-hmm.
So, and I say at least match up to the portion that the employer is matching and contribute up to the what the employer is matching so that you can maximize that. I don't generally encourage to pay in more than that without seeking a financial advisor
Okay.
and determining whether whatever vehicle they're using for that 401k or whatever, that's will maximize their return versus something else that may be available that will give them a larger return. So that's typically what I do. I work with a financial planner, financial advisor,
Mm-hmm.
and because I stay in my lane with my taxes, but I send my clients, to get that consultation,
Yeah.
So everyone needs a good financial advisor and a good tax preparer, and ideally, two people that are working hand in hand because you'll benefit more from that.
Okay, that's good to know. And typically, if someone has a 401k or with their employer or 403b or anything like that, that's usually pre-taxed, right? That's
Correct. Yeah.
So-
So it's reducing your taxable income.
right.
Yeah.
We want to do that, guys. We want to reduce our taxable income. But then we also get the benefit of making more money because our employer is matching it.
Correct.
Okay, good tip. Okay, now I know that you work with a lot of entrepreneurs. That's the bulk of what you do. And I know you do a lot of things outside of tax preparation. And so in thinking about our tax strategies, and I know you've hit on some of this already, what if we want to minimize our liability? Like I said, I know you've spoken to some things. What are some real things that people can do to do that? Besides, well, of course, I'm thinking start a business, but I'll let you talk.
Okay. Well, I mean, there you go. Starting a business. I say that all the time. Start a business. What do you love? And I subscribe, turn your passion into a profit. And if it's not your passion, but it's really a nice size profit, you might want to think about that thing, right? So, that's my first go-to. Is there anything you love doing? And it may be in the realms of whatever you're doing as a W-2 employee, provided your employer doesn't have a non-compete, right? And you're doing it on the side because you may be doing marketing or consulting or whatever, IT, I don't know, but it could be something like that. So start your own, hang your own shingles. That's my thing. Yeah. Hang your own shingles. And let's talk about how you can make your business work for you.
I like that. So someone put, how do I want to say this? Minimize tax liabilities equals hang your own shingle.
I like that. Hang your own shingle.
Hang your own shingle. Or what did you say? Or profit from your passion equals profit from your passion.
Yes.
That whole equation. So minimize tax liabilities equals hang your own shingle equals profit from your passion.
Right.
Somebody put that in the comment section for me. Because once we do that, depending on how we set it up, whether it's as an LLC or sole proprietorship or an S or C corp, that's going to help us. That's going to increase our expenses, right? We increase our income, but we increase our expenses, and we then begin to increase the things that we can deduct, right?
Right. Correct.
Okay.
Correct. Yeah, and that's what you want to do. And you want to make sure that the business is working for you because so we went through the itemized deductions, right? But say you have all those expenses, but it doesn't exceed the standard deduction, so it's no benefit, right? But if you have all those expenses and you have a business, and now we can take the business use of the home and we can at least take a portion of that mortgage interest that you can't take because you have the standard deduction and that real estate tax that you can't take because you can't itemize, you then have the benefit of reducing your bottom line by those things. So you have to be strategic, you have to be very strategic, and there are things that you might even use on a personal basis that are deductible in the business realm. So you want to make sure that you capture, those type things like that briefcase that you might carry at all times, but it's business purposes most times, right? Things like that. So I say while you're out and about, I tell my clients you're out and about, you're, doing your daily whatever, your mindset should be, is this a business expense or is this clearly personal? Now, if it's clearly personal, leave it alone, but it might be gray, right?
Right.
And so if it's gray, then I err on the side of gray. So my other mindset is if it's black and white, it's black and white, period. Nobody needs to wear an orange jumpsuit. But if it's gray, we're going to err on the side of gray and we're going to push the envelope because that means we have a leg to stand on if we need to, mediate on pertaining to that particular issue.
And even with travel, right? If a person has to travel somewhere, is it still true? Like, has anything changed with if I'm going to California and my thought maybe I'm going on vacation, like there's gonna be some vacation time there. So I'm a coach, right? And so I decide, well, I'm going to California. Let me set up some VIP days in California. And so I go and I have a VIP day with a client and at the hotel that I'm staying at. That trip, now does that whole trip now become a business expense or a portion of that trip? How does that work? And I don't want to go down the rabbit hole, but I just know that that's kind of one of the things that I know a lot of people think about is, okay, travel is a big, I know we're not doing a whole lot of traveling right now, but, or maybe you are. Let me not put you in a box for sure. Is that, how would we handle that? Once again, I want people to seek their tax professional, but what is the mindset around that type of thing?
So keep your travel within a 7-day window, right?
So you mean like, if I'm saying like, don't go, I'm going to California for a month or 2 weeks.
Yeah.
Right. Okay. So keep it within 7 days.
That's a little muddy. It can be done. We can work around it, but it gets a little muddy.
Okay.
But keep your travel within a 7-day window, right? This is the simple version.
Okay.
Your plane ticket is fully deductible to and from. Your hotel room is fully deductible during that 7-day period, even if you only met with that client one time. If you choose to take your family, they're staying in a hotel room with you, right?
Mm-hmm.
So you have no further lodging expenses, and the lodging expenses that you are incurring are deductible.
Mm-hmm.
Just need to be mindful of your meals. So because if the whole family goes to dinner, obviously we can't deduct the whole family's meal, right? So you want to just make sure you indicate what you ate and use that as your meal deduction for that particular day. And then of course you want to total all your meals and incidentals and whatever expenses that are incurred while you're away. And what people fail to realize or remember is that when you're traveling and you want to stop and grab that, you're in an airport and you want to grab that coffee or whatever, you're on a business trip. That's deductible.
Okay.
Keep that receipt. or better yet, use that receipt app and take a picture of it. Discard the receipt, it's going to fade anyway, but you have it there. And then you can upload it to your computer and you'll have it forever. Yeah, so it's things like that you want to think about. I strongly encourage that you incorporate business and personal. We have IRS conferences, and typically before COVID, they will announce like 5 or 6 different places that they're being offered, at different times. And I just typically look and see, well, where haven't I been? Where's the weather's going to be nice? You know what I mean? And then I go. But again, I can extend my trip, whatever I do. Even if I drive, that mileage is deductible, right? So I say, take advantage of, again, let your business work for you and let your family reap the benefits, right? So while you're at your conference, they're staying in a room with you, but while you're at your conference, they're at the pool.
Yeah.
They're going shopping. They're doing they're at the beach. I don't know, depending on where you are. I just got noticed that they're planning on, Cabo, whatever that is, St. Lucas or what have you. Now it's in May. I won't be going, a little too soon for me, but but things like that, then take advantage of it.
Yeah.
And stay at that nicer hotel. Remember, it's deductible, right? A lot of times we're like, oh, well, that's too much or whatever. Treat your family. Let that business work for you. The IRS does it for whatever reason. We're always in like the West End or something and paying, $240 a night. So again, let it work for you.
Yeah, that's good. That's good. That's good. And so that's what I would just think for that. If the goal is to minimize your tax liability, start a business. Look, hang your shingles, profit from your passion, and know that you can, when you travel for business or anything like that, most of that is deductible. And of course, I would say, let me ask you this. Do you find that most of your clients consult with you first? I'm sure most tax professionals would prefer that, like, the new year is beginning and they need to know what is the best direction for them. Do you think it's best for people to consult with their tax professional first and then, go throughout the year, of course, instead of waiting until the end of the year when saying, here's my shoebox of receipts.
Right. So yeah, I strongly encourage that. It's funny you said that. I have a client that I just spoke to a week or so ago, and she said, I'm sorry I didn't get back to you. I just finished my 3rd job. And I was like, what are you talking about? Because as far as I know, she owned this business. And she was like, well, I opened 2 other businesses during the course of the year. I didn't tell you. Oh, my bad. What? So we now have no records because all of our clients are on packages and we're doing their accounting throughout the year. But we were only doing the accounting for that one. We were only tax planning for the one. We had no knowledge. So yeah, I would strongly suggest that you meet with your tax person. They're not there just to prepare your taxes. And if you have a tax preparer that's only preparing your taxes, you need another tax preparer. You need one that can work with you for tax planning as well as tax preparation, for sure.
Yeah, that's good. I hope you guys got that. A professional who you can consult with.
Correct.
Because they're going to be able to tell you things on the front end that you can consider for your taxes, for your personal taxes, for your business related taxes, that will help you throughout the year. And so that tax planning is really, really key. Yeah, that's some good advice, because I don't even really think I had thought about it like that, because I really have not used my tax professional, who is awesome, just like you. She's awesome like you. had not used her or consulted with her in that way. And so that's something I need to make sure that I do.
Yeah.
To ensure I'm getting the best bang for my buck.
Right, exactly. And then they can better advise you, just based on your business. Do you have children?
Mhm.
How old are your children? Are there some age appropriate things that your child can do within your business where you can pay them? Because let's remember that the standard deduction is now $12,000. So not that we're necessarily going to max out to $12,000, but if you put them on your payroll because they're stuffing envelopes or cleaning your office or whatever, that's less taxes that you're paying, right?
Mm-hmm.
Meet with your tax person
That's
and
good.
help them to help you figure those strategies out.
Mm-hmm. No, that's good. I didn't even think about that. Kids as employees and how that really benefits us as well.
Yeah.
Ooh. I mean, I know there's so many things. I mean, guys, the purpose of today's Navigating Now wasn't necessarily, of course, we can't go down every detail of everything that you can do. Did want to give you some things to think about as you are planning for your taxes for this year, but really going forward. Because what is now for 2020, but we can start thinking about these things for 2021, and it also hopefully will have you ask certain questions of your tax professional, because if you have a really good one, they're going to know all the things that you can do. They're going to know the black and white areas. They're going to know the gray areas. They're going to know. But if you just have someone from around the way who's doing taxes, and you owing every year and you're trying to figure out why, you may need to get someone else. Right. And get someone who can help you plan for not owing as much as possible. Right? Because just like, I'm sure, Wanda, just like you don't want anyone to have to, now if you're making millions of dollars, I mean, I'm talking kind of regular, because if you have a business, and you're making multiple $1 million, you're going to owe some taxes, Well, although I know somebody who didn't pay. Okay, I'm not going to get political. I'm sorry. But we know corporations have loopholes too. I mean, they have things that they do to reduce liability. Everybody has things that they can do to reduce their tax liability. You may as well have something that you can do to reduce your tax liability. Let me just say it like that. Right. So this is just, and let me finish my thought. Slow down, Jocelyn. Just like Wanda doesn't want you to have to pay $10,000 to get paid $10,000 of a refund. She doesn't want you, especially if you're an employee, doesn't want you to have to pay $10,000 either, because there are people who are paying because they're not using strategies to reduce that liability. Correct. So that's really the purpose for this. Now, I'm trying to keep it as close to an hour as possible. I know we're running out of time. We're going to make it over just a little bit. One of the things that you do, and I know you can't go in depth about it, but Wanda is a master at tax resolution. Tell me, what is tax resolution, and when would someone need something like tax resolution?
Tax resolution is when we get the taxpayer to sign a Form 2848, which is an IRS power of attorney, right? That gives us permission to contact the Internal Revenue Service on the taxpayer's behalf. What it also does is it tells the IRS agent that this taxpayer is no longer accessible to you, so it avoids that knock on your door. Because once that 2848 is in place, the revenue agent has to come to us to speak to us about whatever the issues may be. Typically, our guide is $10,000 or more. If you owe $10,000 or more to the Internal Revenue Service, you definitely need someone to mediate on your behalf, because there are loopholes and you do have rights. But If you don't know your rights, you don't have it, right? So we have had cases where as though the revenue agent went and knocking on the door, the taxpayer sang like a bird and then came to us. So we get the 2848, we're having a conversation with the revenue agent, and the revenue agent is like, that's not what they told us. Now, don't get me wrong, we're not deceiving them, but there's certain things that they can't ask for, right? But if you don't know that, it's just free reign. So $10,000 or more. And I say that because if it's under $10,000, it's typically something that you can probably handle yourself, right? And what you would pay to retain us, it probably wouldn't, balance out or make sense to retain us for a minimal, 5, 8 or whatever $1,000. So then you retain us, and then you have options. Let's look at your financial situation. Do you have the ability to pay? Because believe it or not, there's something called currently non-collectible. It's like, okay, my client does not have the ability to pay. This is their financial statement. This is their circumstance, and we need you to put them on a currently non-collectible list. That gives the taxpayer 18 to 24 months without the IRS on their back. But when the IRS is ready to open it back up, and then they'll knock and like, is your client in a better situation? One, they have to come to us. And two, if you're not in a better situation, we're telling you the same thing, and it's buying you more time, right? There's something called an offer in compromise, whereas though you tell them, you owe the IRS $50,000. And once we look at your financial situation within that 6-year time span that they generally give you, you're unable to pay that back based on your financial situation. And we're telling the IRS, well, my client can't pay 50, but they can pay 25. This is their situation. This is what they have, and submit it to them. It's a process. And especially with COVID, right? It's taking them longer than normal to go through those. But you pay 20% down of what you're offering. You make monthly payments. And then once they accept it, which the acceptance rate right now is between 30 and 40%. But once they accept it, then typically you'll have 24 months to pay the balance, right? So there are different strategies that we can use. Now, with that offer, you may not be able to offer 50 cents on a dollar, that 25 to that 50. And you may only be able to offer, 5,000. But if your financial situation, is that grim, if you will, they've been accepted as well. I've had a revenue agent just shake his head and sign off like I can't get blood from a rock. And $35,000 just disappeared off of the client's, records. So yeah, I just say, don't go it alone. But if you owe less than 10, you can typically call the IRS and set up payment arrangements or whatever, or actually go to irs.gov and put in installment agreement and put in your information and set up your own installment agreement through irs.gov. But if you have a situation where you're looking at liens and levies and things of that sort, you want to make sure you retain a tax resolution strategist. And that's what we do.
That is so good.
Yeah.
So it's somebody put this in the comment section. What is a tax resolution form? What form would they need to fill out? The 2848?
Well, the tax resolution or tax liaison will give them a form 2848.
Okay.
To complete. And we complete it because there's certain information that we have to put on it, right? And so once they sign off, they can sleep better at night. I've had a lady tell me I was losing sleep, you know what I mean? And once we step in, then there's been many who've said, I sleep better, I'm not stressing anymore, or what have you. So yeah, we are your liaison, your gatekeeper, whichever term you want to use, between you and the Internal Revenue Service.
No, that is awesome. That is really good. So just remember this, if you owe 10,000 or more, you may definitely want to look at hiring a person that is skilled. Let me say that again. That is skilled at tax resolution. Because just because a person is a tax preparer does not mean that they are skilled at tax resolution, right?
Well, the thing with that is, if they're not an enrolled agent, which we are, if they're not a CPA, and if they're not an attorney, they can't mediate on your behalf anyway.
Ah,
So a lot of tax preparers are tax preparers. So you want to look for an enrolled agent,
that's
which
good.
means that's what we are, which means we're certified on behalf of the Internal Revenue Service to mediate on your behalf. An enrolled agent is required to have 16 hours of continuing education credits per year and 78 hours total every 3 year time span in order to keep the certification. And the reason for that is because the tax code is always changing, right?
Okay. Mhm.
So you want to make sure you retain an enrolled agent, a CPA, or a tax attorney.
Oh, that's some good information. So, bump what I just said. The person has to be one of those three, an enrolled agent, CPA, or an attorney to even be able to um, speak on your behalf for tax resolution.
Correct.
Okay. No, that's good. That's good. I have one more question, and I don't even know if I want to go here, but I'm going to go here. And I'm backtracking a little bit.
Okay.
So I was thinking while you were talking earlier about our records, making sure we have our good records and things like that. And I feel like I need to just make sure we're all clear on this when it comes to income that you receive from people. So this is for the person who is, working to profit from their passion, or at least profit, it may not be your passion yet, but, do something to help minimize the tax liability by starting your own business. And can we talk about integrity regarding recognizing income that you bring in or revenue that you bring in from your sales? Because I know in a lot of instances, say somebody doesn't give you, a 1099 or whatever else. I mean, I won't get into forms and all that, but someone give you something that shows the IRS, yes, I paid this person, $1,000. But you had a client here, you had a client there, you've been braiding hair, you've been, doing that thing, that business is building. And you may decide, hey, I'm not gonna report all my I don't have to report income because it's coming to me in cash. Like there's no way to trace it, there's no way to, nobody will know. Can we talk for a second?
Sure. There was a time when the revenue agents were knocking on the doors of barbers and stylists. And the reason for that was they knew they had no records. They knew they had none. And so when they get into the audit process, they're asking to see their schedule, of appointments, their appointment calendar, and whatever else. And they were actually estimating what the income should have been and comparing it to what it actually was. They were also estimating what the tip income should have been as well. Right? So it is important that you keep good records and that you do report what comes in. So let's just say you have a business bank account and you have checks and you have cash. Well, the cash comes in and you put that in your pocket, and the checks come in and you put it in the bank, but you're only reporting what goes into the bank. If the IRS knows that you operate business in cash, they're going to be looking for that additional, right? So, years back, there was no such thing as a 1099K. But now there's a 1099K, which means the merchant, whoever you run your credit card purchases through, is now required to give you a 1099 saying this is how much you process in credit cards, but that copy is going to the Internal Revenue Service as well. Right? So just kind of be mindful of that because they do know that. But again, the IRS is there. So they believe that anything that you bring in is taxable.
Mm-hmm.
That is the mindset, that is the tax law and what have you. So I'd say keep good records. And just because you did not get that 1099 does not mean it is not reportable. And then keep in mind that say you don't get the 1099 and you decide, well, I'm not going to report it because I didn't get the 1099. But whoever should have issued that 1099 is audited. And then they see that you were paid. And for some reason, you're in that audit trail, which I've seen. I've actually represented a client who was notified of an audit because his tax preparer was being audited because she was giving her clients a hookup. That's a whole nother segment, right?
Yeah.
That's the Mo money. Come to me and I'll get you Mo money.
Yeah.
Run, just turn and run. So what happened was she had literally recorded trucks that he didn't own, minimal income, but he was living in a 4,000 square foot home. So the IRS wanted to know, well, if this is all you're generating, how is your family living like this? By the time he came to us, they had requested all receipts. They wanted, that's when Blockbuster was out. They wanted Blockbuster receipts. They wanted dinner receipts. They wanted utility bills, mortgage statements. They wanted everything. And then they're like, there's no way that this is your only income with all of these expenses. So I just say that to say, yes, please operate with a level of integrity. And because it could come back on you. It really could come back on you. Yeah.
Wow.
Now, that part is not worth it. And just to take it a step further, when it comes to expenses, you know, I said there's a black, and white, and a gray. But if you're a construction company and you're shopping at Kay Jewelers and it goes through, I've had cases. I've seen, it's real life people. I just have to say that this is real life. I've seen taxpayers have to walk around with a, what is it, the tracer on their leg. And I've also seen them go to jail for tax evasion. So it's real. I know a lot of times we hear that, oh, we don't want to go to jail. We don't want to, you know, but a lot of people think it's just a joke. Oh, that doesn't happen.
Right.
It happens to the common person, not just the stars that we see that are locked up for tax evasion. It happens to the common person. Yeah.
Oh, that's good. I didn't even think about that. One of the other things that I was just thinking about, because you mentioned it too, is, and I'll try to make this my last, I have this question and one more question, is around tax audits, because, you know, that can strike the fear, you know, that just strikes the fear in the hearts of people when they hear about the fact that they are being audited. What can we do to prevent audits? But if we can't, how should we prepare ourselves for an audit? What can we do?
Okay. So I don't subscribe to the mindset that you can actually prevent an audit, right? I do subscribe that you can help to minimize the chances of being audited, right? Some of those things are those deductions that you know are red flags, like meals. You know what I mean? Your meal expenses, $5,000 or $10,000 for the year. That's going to flag the IRS. Like, really? So if in fact that's the case, again, I'm not saying don't take it if that's the case, if you can justify it, but just because your family's going out to dinner, that is not a deductible expense. The other one is mileage. There was a real estate agent who had reported 26,000 miles on the tax return, who had no mileage log. Now, we all know during this time, the market was booming. So we all know that real estate agents have a good amount of miles, right? They were totally disallowed, which equated to roughly $13,000 in deductions because there was no mileage log. So they're looking at, those things that may seem overstated. They're also looking at your return to see if they all end in zeros. A lot of people don't know that. So all of your expenses end in a zero. That tells the IRS you don't have any records. Because there's no way every single one of your expenses or the majority of your expenses were in even 200, 300, whatever. You know what I mean?
Wow, I would have never.
Yeah, those are the things you really need to keep in mind. And to avoid that, just track your expenses, track your income, track your expenses. And if you're not to the point where you're ready to hire a bookkeeper or an accountant or what have you, then use a spreadsheet. Use a spreadsheet and do your columns by month and then have your total at the end, right? So just make sure you have supporting documentation. Those are the things that will prevent or reduce the chances, if you will, of you being pulled. There's really no one that can totally avoid an audit because some audits are just random. Your number's up. We want to look at it. You know what I mean? But as long as you have your documentation, you're fine. What I will say is don't go it alone because the revenue agent knows that you don't know tax law and they'll ask you for anything. If you have someone representing you, then they can say, oh, pause. That's not on this list. That's not a part of this audit. You cannot ask for that. All right? So those are the things that you can kind of keep in mind. Yeah.
That's some good stuff. Okay, so my last question is regarding the new PPE or the potential PPP, right? The Biden administration is trying to get a new PPP, correct?
Well, they've already approved the second round of PPPs. And as all the tax law, it changes all the time. If we're speaking on the gig workers that we're talking about, the Schedule C filers or what have you, they did just pass an addendum to the PPP qualifications, whereas before it was based on their net income. And if you can imagine, a lot of the smaller business owners, their net was minimal, right? Mm-hmm. And the formula is you take your net divided by 12, multiplied by 2.5, and that's what you qualify for. So some people will qualify for 800 or 1,500 or whatever, which again, very minimal. But now they recently just changed it so they're now looking at the total gross income, which is phenomenal. It's really awesome for that small business owner. So they're looking at the total gross to determine what you qualify for now. And now more small business owners are, qualifying for larger amounts, which is awesome because I'm sure you heard of the larger corporations that got millions of dollars.
Yes.
You know what I mean? Who didn't even need it, and it left the smaller businesses, the mom and pops and what have you, kind of out there. And then the other thing that they put in place, which really warmed my heart, is the fact that there's a 2-week span between February 24th. It started Monday, the 24th, and it's like a 2-week span out that banks can only process PPPs for small business owners with 20 employees or less, which is huge. Because they were getting put on the shelf because of the time that it was taking to process the larger ones. So now no major corporations, no big businesses can be processed within that 2 weeks time span. So if anybody's on here, you're a business owner, you're a small business owner, 20 employees or less, go to your bank and apply for your PPP, because you then have priority. You're going to be put at the front of the line now.
And so, okay, so just to make sure I understand and to make sure my people understand.
Mhm.
So do they have to have filed already before they can get the loan, or it's not contingent upon that? They just have to, do they have to
File their taxes?
Yeah. So this
No.
is not based on, this is just, so for 2020, if I am a person that has my own business, I have to show some proof of my income, correct?
Yeah, well, it actually really depends. I've seen different ways. It depends on what bank you're working with, to be quite honest. I've seen some, clients who really didn't have to show much of anything, and I've seen others that had to show. But what they're trying to see is that, one, you were in business. If it's your first time, by February 15th, they want to see some sort of activity around the February 15th time period to show that you were actually in business.
Okay.
Around that time. If you're a second time PPP recipient, in order to qualify, you have to show that one of your quarters in 2020 was 25% or more or greater, less than what it was in 2019. Right?
Okay.
So in order for that, you do need to have financials. You need to have supporting documentation.
Okay.
So, those are things, but, it's easier. The process is seemingly easier and a lot more smooth when you use the smaller institutions. But two, like I said, you do have priority now during this 2-week time span, so you can go to the bank and as a small business owner and have it processed.
Okay, so I was incorrect in my thinking. So it's not based on 2020 income per se. Like if I'm a first time, if this is your first time with a PPP loan, is it based on 2020? Or if I started my business January 1st and I, got a couple of clients, so they're going to base it on this year's revenue or income or 2020 or?
Yeah, well, if you started January 1st of this year,
then I wouldn't get it.
I'm sorry?
Then I wouldn't get the loan?
Yeah, I think they're going to be looking at, and I could be wrong, but they've been looking at 2019 and 2020. So
Okay.
if you're just in business in 2021, I don't believe you'll qualify.
Okay, I just wanted to make sure. But if it's 2020 and it's my first time and I may have started my business in October and I only got $5,000 of income in 20, I can still go and apply.
Right. And then you just need to show that you had activity that around that February 15th time span.
Okay.
I don't know what's significant about February 15th, but that's the time span that you have to show that you were actually operating in order to qualify.
So if I had business, if I was doing some business at the end of, like I started in 2020, but January was dry, like nobody bought anything I had to sell, then they'll be like, well, ma'am, I don't know if this is a function business because it's February 15th and you haven't had any income in 2021 yet.
But you can show that you were in business because you have your business license. You can show that you paid expenses through your bank account. You can show that you maybe paid a couple employees on payroll or what have you. That shows that you still had a viable business.
Okay. I just wanted to put that out there. If anybody's out there and you're like, oh, I didn't know if I could get my PPP yet, so. But once again, if you're working with a tax professional, they should be telling you that. Yeah, they should be letting you know that.
Yeah.
Okay.
And that, that's changing all the time. So make sure that, you stay in contact with your tax person to, help you. And the banks they're designating certain areas, that are just focusing on PPPs and what have you. So I have a few clients where the actual banker will contact me for the client's information. So, your accountant would probably be able to assist if you're in that situation.
Okay. Awesome.
Mhm.
Awesome. Once again, I always say this, we could talk for 10 more hours. But I think I'm going to end my questions there. Is there anything, Wanda, that the people need to know that we haven't said, or if there's anything, is there any point that you want to make sure you reiterate before we finish today?
My main point is make the money, and just make sure you have a relationship with a tax planner, not just a tax preparer. Make sure you have a relationship with a tax planner so that you can keep more of what's yours and not give the IRS what they think is theirs.
There you go.
And there are so many other strategies that we could get into that we just didn't have time. And a lot of them are contingent upon the type of entity, that you formed with your business. So another reason why it's important to have that relationship with a tax planner. Yeah. And with that being said, I don't know if this is politically correct or not, but I would say avoid the H&R Blocks and the Jackson Hewitts and things of that sort, because that's what they are. They're tax preparers. They're not tax planners. So develop a relationship with a tax planner.
Okay. That's good. Oh gosh, and of course you said something that made me want to ask another question, but we're already like going long about entities. But we can always talk about that on another time. I won't do it. We'll be on here another 20 minutes. Okay. So Wanda, how can people reach you if they want a tax planner and not just a tax preparer?
Okay. So they can give our office a call. We are in Virginia, but we have clients all over the U.S. And that number is 757-410-8030. That's 757-410-8030. They can email me directly, wanda@premiersmallbusiness.com. Or they can go to our website. And if you go to our website, premiersmallbusiness.com, you can actually fill out a request for a consult. And we do offer 30-minute consults at no charge. So when you fill out the form, you can just indicate a couple days and times that are good for you, and we'll get back in touch with you and make sure that you're scheduled. And like I said, we'll do a 30-minute consult at no charge.
That is awesome. So please put that in the comment section. Wait a minute, hold on. Please put that in the comment section. I had some feedback. Wanda's number, her office number is 757-410-8030. 757-410-8030. Or you can go to Premier Small Business, if somebody can put that in the chat, premiersmallbusiness.com. You can actually sign up for a consult. Please, guys, please. I am all about us taking everything to another level, all about us, really understanding where we are now so that we can navigate our way to where we want to be. And so I think that this is vital. I mean, this is just another way for us to be intentional about how we want our life to be. And yes, we're talking about taxes, but as you've even just from this conversation alone, I know I've even learned a whole lot about it. You can really learn to manage your income. You can prepare your family financials for the long haul, even just by doing particular tax strategies and for doing tax planning. And so I am asking you to take that on. And the fact that Wanda and her team provide a 30-minute consult that's free, I would say check her out for that. I mean, you're going to want to work with her. I already know that. But do that consult. Do that consult. You've heard us talking today. you want to minimize your tax liability. You want to find something that you can do to increase your income so that you are bringing more money into your home, so that you can, save for the future, so that if you have kids that need to go to college, you can have funds set up for that, or for retirement, or for whatever to travel. I don't care what it is. And so this is just one of those ways that you can do that. And so I am definitely encouraging you to reach out to Wanda. And if it's not Wanda, that's okay too. If you have your own tax planner, I suggest that you utilize them for more than just preparing your taxes, that you really utilize their knowledge to help you map out your year before the next time that you have to file. And so I just know that will be so beneficial to all of us. Okay, so Wanda, I've been asking everybody a question, and I was going to ask you another question, but I think I'm just going to ask you one question today. I'm a lover of books, and I love to read. I feel that they just, help us in so many different ways. You currently reading something that you would like to share with us, or is there a book that you have read in the past and you're like, oh my gosh, you all have got to read this? What's on your reading list or your listening list? Because I recognize everybody didn't have time to sit down and read. You may be listening to something as well.
Yeah. Listen, my go-to for listening, honestly, is Sarah Jakes Roberts, Lover. And so I can just play that in the background all day and absorb her wisdom and just what she offers. What my reading list, I must say that I start books and I don't finish them, they pile up and then I start another one. But I do get back, I do finish them, but I'll start another one before. So Marshawn Daniels.
Yes.
Yeah. Was it Believe Bigger?
Yes. Yeah.
Awesome read. Just awesome read. I'm really big on personal development and what have you. So that's an awesome read. And then the other thing is the one thing that my business coach, Love Her Dearly, gave us to read. The one thing, focusing on the one thing to help build your business. And it doesn't mean that you don't have other aspects of your business that you offer as services, but what's that one thing that's going to get you to where you want to go in your business, that one service or what have you that you offer to get you to where you want to be. Yeah.
And that's called The One Thing?
It's called The One Thing.
The One Thing. Okay.
Mm-hmm.
The One Thing, Believe Bigger by Marshawn Evans. And then you also mentioned Profit First earlier in the discussion. Okay. So we got 3 books, y'all. We got 3 books. We'll write those down. Somebody write those down in the comment section. But we were talking technical matters, sort of, but that time went by fast, at least to me. And so, all right. So I just want to thank you, Wanda, for being here with us on Navigating Now, talking about navigating tax strategies. And I would say tax strategies and tax planning. Mm-hmm. I just thank you for your wisdom. And God, I know has graced you for this. And I know you are a blessing to your clients, as you have been for me personally and for this audience, I know. And so I wish you many, 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 many blessings. And on that note, that's a wrap, guys. Mm-hmm. This is Jocelyn Harrison. Thanking you so much for being here with us for Navigating Now. And that's it. Peace. We're out. Bye, everybody. And thanks for watching. Have a great week.